Okay, I want everyone to just take a deep breath, because if you have looked at your portfolio this morning, if you've pulled up the charts on this lovely Monday, February 9th, 2026, you are probably feeling something between, nausea and just total, utter confusion. But we're going to sort all of that out today on Fly or Fall Stock Market Analysis.
So, Keri, you just talked about nausea and sickness when it came to everyone's portfolio, but I think whiplash is probably the polite word for it.
Yeah, financial vertigo is probably more accurate for what we're all feeling right now, right? Because let's just set the scene for a second. I think we need to acknowledge the emotional roller coaster we've all been on.
Oh, absolutely. Not even a week ago, we were, popping champagne. Silver was trading at highs that honestly most of us never thought we'd see in our lifetimes. We were up around, $121 an ounce?
$121. Yeah. The silver squeeze was the trending topic on every platform. It really felt like the breakout had finally happened. It felt like the vindication of a 20-year thesis,
It was euphoria. Pure and simple. The sentiment metric were completely off the charts. Everyone thought the ceiling had been shattered, and we were in blue sky territory. The moon was the next stop. And then in a matter of 48 to 72 hours, the floor just ceased to exist. Vanished.
We watched a smash that took us all the way down into the 70s from $109. It's a 33% haircut. I mean, in less than a week. That's not a correction. That's a collapse. So the mission for today's Fly or Fall is simple, but it is, I think, really urgent. What on earth just happened? And the more important question is this the end of the bull run? Is the party over? Or is this the biggest bear trap in history?
It is the question of the decade, I think. And to answer it, we have to do something that is, very difficult for our psychology to do. We have to look away from the price ticker. And that's hard to do.
It's the mistake everyone makes. They see that red line going down, and they just assume the asset is dying. But if you look at the plumbing, the physical vaults, the lease rates, the actual metal moving around the globe, the story isn't just different. It's diametrically opposed to what the price is telling you. And that's exactly what we're digging into today. We have a massive stack of sources in front of us.
We've got the technical breakdowns from OG John AG. We have some macro analysis from Clive Thompson, and we've got the raw data coming straight from the Shanghai Futures Exchange and the COMEX.
And we're also looking at some really interesting reporting from investing.com and FX Empire that sort of ties it all together, right? So we're going to cover the bull case and the bear case. And we aren't going to sugarcoat either of them, because if you are holding silver or you're even thinking about buying this dip, you absolutely need to understand the risks on both sides of this trade. Is this an opportunity or a trap,
Exactly, because right now we have a paradox. The paper price says crash, but the physical data is screaming shortage. So let's start with the crime scene. Walk me through the anatomy of this crash. What actually triggered this between, say, January 30th and February 6th? Because it didn't feel natural. It felt mechanical.
It felt very mechanical. It wasn't natural. And if you want to find the smoking gun, you have to look east. You have to look at the Shanghai Futures Exchange, the SHFE. That's where the first shot was fired.
Okay. I kept seeing mentions of the Shanghai Six in our research notes. It sounds like a bad spy movie. Or maybe a Western. Who are they?
It does sound cinematic, doesn't it? But it's very real market mechanics. So on February 5th, the Shanghai Futures Exchange issued something called Notice Number 37. Now, exchanges issue notices all the time, right? Usually it's boring administrative stuff, holiday hours, slight rule tweaks, that sort of thing, right? Stuff no one reads. This was different. This was a public shaming. They explicitly banned 6 groups of linked accounts.
Okay, pause there. When you say linked accounts, what does that actually imply in trading terms? Why does an exchange care if accounts are linked together?
It implies collusion. It's these chains basically saying we caught you. It means you have 6 different entities. Maybe there's 6 different shell companies or 6 different trader IDs pretending to be independent actors in the market, but in reality they are coordinating their buy and sell orders.
So, they're a wolf pack?
Yes, they're working as a wolf pack. They are moving together to manipulate the price in a specific direction, and that is highly illegal.
So it's not a free market at that point. It's a rigged game. And what exactly were they caught doing? What was the crime?
They were executing a massive, and I mean massive, short attack. According to the data that OG John AG was tracking, in a single morning session, we're talking just a few hours of trading, these 6 accounts dumped 674 million ounces of paper silver onto the market.
Okay, I want to stop on that number because numbers that big, they just sound like a lot. They lose their meaning. Can you put 674 million ounces into perspective for us?
I can. Let's try this. Global mine production, that's the amount of silver every single miner in the entire world pulls out of the ground in a full year, right? From Mexico to Peru to China, all of it is roughly 850 million ounces.
So let me get this straight. In one morning, in a few hours, these guys sold on paper nearly an entire year's worth of physical global supply. On paper?
Yes. They sold promises for silver that, let's be honest, almost certainly does not exist. Or at least they sold claims on silver that are equivalent to a full year of human effort, geology, and mining for the physical stuff.
That's just absurd. How is that even allowed? How does an exchange system allow a year's worth of supply to be dumped in 3 hours?
That is the strange reality of the paper market. In the futures market, you don't actually need the metal to sell the contract. You just need the margin. You just need the cash deposit, the down payment, right? But just think about the basic mechanics of supply and demand. If you flood any market, I don't care if it's strawberries, used cars, or silver, with a year's worth of supply in 3 hours, what has to happen to the price?
It has to crash. There's no other outcome.
It has to crash. The algorithms see that volume coming in. They see the bid stack just getting obliterated, and they panic. They sell. It triggers a cascade, a waterfall of selling.
So the initial drop wasn't because people suddenly hated silver. It wasn't because a new massive silver mine was discovered on the moon or something. It was a coordinated, manipulative dump.
Precisely. And the Shanghai regulator even confirmed it in their notice. They called it abnormal trading behavior, and they restricted their positions. They basically slapped them on the wrist and said you can't do that. But by then, the damage is done. The chart is broken. The psychology has shifted. Panic has set in. And that panic, it traveled west very, very quickly.
Which brings us to the CME, the Chicago Mercantile Exchange, because right after that, we saw margin hikes trending on social media. I feel like people hear margin hike and they know it's bad, but they don't actually know how the mechanic works. Can you sort of, explain that for us? Why does a margin hike crash the price?
Sure. It's actually quite simple, but it is devastating in its effect. Think of a margin like a down payment on a house. If you want to buy, or in this case, short, or just trade a huge amount of silver futures, you don't put up the full cash amount. You don't put up, $121,000 for a contract. You put up a small deposit, maybe 10 or 15%. That's your margin.
Okay, so with a little bit of my own money, I can control a lot of silver. That's leverage.
Exactly. That is leverage. Now the exchange, the CME, they act as the clearinghouse. They're the referee, and they're also the insurer for the whole system. If you make a bad bet, and you go bankrupt, and you can't pay the person on the other side of your trade, the exchange is on the hook.
Okay?
They have to cover your loss to keep the entire system whole, right? They are the backstop. They can't let the whole thing collapse. And they hate risk. They are allergic to risk. So when volatility goes crazy like it did after that Shanghai dump with the price swinging wildly by tens of dollars, the exchange gets very, very nervous. They say this is too dangerous. We need a bigger buffer from everyone. So to protect themselves, they raise the margin requirement.
They demand a bigger down payment from everybody in the game.
Exactly. They send out a notice that says, hey, yesterday you needed $10,000 to hold this position. Today, because things are crazy, you now need $15,000, and you need to wire it to us by the close of business today. And if you're a leveraged speculator, maybe a small hedge fund or a day trader, and you don't have the extra $5,000 just lying around per contract, and you might have hundreds of contracts, you get what's called a margin call.
Yeah.
And you're forced to liquidate. You have to sell your position immediately, at whatever the market price is, to pay the exchange back, or to just close the position so you don't owe that extra money. So the exchange raising margins, it forces people to sell, which creates more selling pressure, which drives the price down further, which might trigger more margin calls. It is a death spiral. It pours gasoline on the fire. And the CME didn't just do this once. They raised margins 3 times in 10 days. 3 times.
That is incredibly aggressive. It's a message. It flushed out almost all of the leveraged speculators. It's their way of cooling down the market by forcibly evicting the people who can't afford the new higher rent.
It feels like the system is sort of rigged against the little guy in that scenario, or at least it's rigged against the leveraged guy. Well, OG John AG made a great point in his report about this. He said, exchanges don't raise margins out of comfort. They raise them out of fear. They aren't trying to hurt you specifically. They're trying to save their own system from collapsing under the weight of all these volatile bets. But the side effect is, yes, a price crash. It wipes out the weak hands.
Okay. There was one other factor in the crash section of our nets that I want to touch on. The Kevin Warsh factor.
Yeah. It's about the algorithm logic. We have to remember that something like 80% of trading these days is done by machines, not humans.
So President Trump nominated Kevin Warsh to the Federal Reserve. Now, whether you like him or not, that's irrelevant. The market has a specific tag for Warsh, and that tag is hawk.
Correct. A hawk is someone who prioritizes fighting inflation over keeping employment high. It means he likes high interest rates and, crucially, a strong US dollar. And the standard correlation that's programmed into every trading algorithm on the planet is if interest rates go up and the dollar gets strong, you sell metals and you sell crypto. That has been the trade for 20 years. It's almost muscle memory for these machines.
It's a complete knee-jerk reaction.
Totally. It triggered a risk-off event across the board. The bots saw the news headline. Warsh nominated, they scanned their database, saw the tag hawk, and instantly sold. We saw Bitcoin drop down to the $60,000 range, and silver, which has been trading in lockstep with risk assets, recently followed it down like a puppy on a leash.
So to just summarize this whole anatomy of the crash, we had a massive, likely illegal short attack in Shanghai, followed by the Chicago exchange, basically forcing traders to sell via these aggressive margin hikes. And it all happened while a macro-political event scared the algorithms into just dumping everything that looked like a risk asset. That is the perfect storm.
Yeah.
And it explains the high-O paradox that we are seeing right now. Okay, so that explains why the screen in front of me says silver is in the 70s. And if you are a casual observer, you say, well, silver crashed. Game over. Right? Move on.
But this is where the deep dive really begins. Because if that was the whole story, we'd just pack up and go home. But we have this other entire stack of data, the physical vacuum, the high-low paradox.
Yeah. Explain what we're seeing in the physical market, because I'm reading these reports of premiums in Shanghai being 8 to 10 over the spot price, and in some cases, the disparity hits $40. What does that mean?
It means we have two different worlds. It creates a massive arbitrage opportunity. Think about it. If you can buy a 1-ounce silver coin or a bar in London or New York for the paper price of, say, $75, and then you could instantly sell it in Shanghai for $85 or $95 or even $110 in these extreme cases, what should you be doing? You should be doing that all day long. It's free money. It's free money, which means physical metals should be flowing from west to east. It's moving at record speed. The physical metal is literally being sucked out of the west, where the price is suppressed by these paper games, and it's being shipped to the east, where the industrial and strategic demand is absolutely voracious.
This is where we get into the bull case proper.
Yes, and there's a framework here from our source material that I think is brilliant for understanding this. The folks at Goat Academy call it the Winston framework. I love a good framework. It helps organize the chaos. Let me break it down for you. It's an acronym that stands for vault, pressure, and position. And we have to start with the vaults, specifically the COMEX vaults. This is the physical inventory that is supposed to be backing up that paper price.
Okay, I checked these numbers and honestly, it's confusing. There's eligible and there's registered, and people seem to mix them up constantly online. What is the difference, and why does that difference matter so much right now? It's the most important distinction in this whole story.
Think of the COMEX vault like a giant Costco warehouse. Eligible silver is just stuff sitting on the shelves in the back. It's in the building. It meets the quality standards. You know, it's a 1,000-ounce bar 999 pure, but it might belong to me or you or a family office or an ETF like SLV. It's just being stored there, but it is not for sale. It's tarked. It's like your car in a public parking garage. Just because it's in the garage doesn't mean the garage owner has the right to sell your car. So just because the total number of ounces in the vault is high, it doesn't mean you can actually buy it. Most of it isn't for sale. Now, registered silver, that is the stuff in the for sale aisle, right at the front of the store. That silver has a warrant attached to it. It is exclusively available to settle a futures contract for immediate delivery. That is the actual liquidity of the market.
So, if I buy a futures contract and I decide I want the physical metal, I stand for delivery. The metal must come from that registered pile.
Yes, and that pile is vanishing.
Okay, give me the numbers. How bad is it?
The official registered inventory has dropped to around 103 million ounces. Now, depending on who you ask, some sources strip out what they call encumbrances and claim that some of that registered silver is already spoken for by other parties. The real available liquidity could be closer to 80 million, maybe even lower on some days. But let's be generous and stick with the official 103 million. Is that a lot? I mean, it sounds like a lot. 103 million ounces of silver is a big pile of metal.
Context is everything here. In the month of January 2026 alone, just last month, 50 million ounces left the vaults. 50 million in 1 month?
Yes, and compare that to January of 2024, just 2 years ago. In that month, only 6.8 million ounces left.
So the drain rate has increased by, what is that, something like 700%?
Roughly, it's a run on the bank. The metal is leaving the for sale aisle and going into private hands much faster than it can be replaced. If you have a 100 million ounces of inventory and you're losing 50 million a month, you do the math. You have 2 months of inventory left. That is the very definition of a supply crisis.
Okay, so that's the vault part of the Winston framework, emptying at an accelerating rate. What about the P for pressure?
Pressure is a leverage. It's the ratio of paper claims to the actual metal. Right now, the open interest, that's the total number of outstanding paper contracts promising silver, represents about 429 million ounces.
So you have 429 million ounces worth of promises, but only 103 million ounces of actual silver in the for sale pile to back it up. So that's a bit more than a 4-to-1 leverage ratio, right? 4 claims for every 1 ounce.
Now, usually the skeptics and the bears will say, so what? That leverage is normal for a futures market. Most people trading futures are just speculators. They don't want the metal. They just want the cash profit. They'll roll the contract over, which has been true for decades. That's the whole argument for why the price doesn't explode, because nobody ever actually shows up and asks for the silver.
It has been true, and this is the huge flashing red, but that behavior is changing dramatically.
Yeah.
This brings us to the March crisis math that Clive Thompson has been shouting from the rooftops about. March is a major delivery month on the COMEX calendar, right?
It is. The futures market has active months and inactive months. March is one of the big ones. And the precedent that was set in January and February, which are usually very quiet months, is terrifying for the banks who are short. In February 2026, delivery fans were nearly 98% of the open interest.
Wait. Say that again. 98% of the people holding contracts said, I don't want the cash. Give me the metal.
Yes. Historically, that number is like 5 to 10%.
That is a sea change. I mean, that's not speculation anymore. That is industrial panic.
That's what it looks like. It's people saying, I don't trust the paper. I don't want the cash. I need the physical bar in my hand to run my factory. Now, apply that new behavior to the March contract. First notice day is February 27th. That is less than 3 weeks away. If that behavior continues, if even, let's be conservative, say 25 or 50% of the March contract holders stand for delivery. Okay, let's do the math on that. If the open interest is 429 million ounces, 50% of that is over 210 million ounces, and there are only 103 million in the registered category.
The math doesn't work. They don't have it.
It breaks. The exchange physically cannot fulfill its obligations. This is the squeeze everyone has talked about for years. It's not about the price going up to some magic number. It's about the delivery mechanism seizing up entirely. It's like an airline that sold 200 tickets for a plane that only has 100 seats. And suddenly, for the first time ever, all 200 people show up at the gate demanding to get on.
And this has to connect to the lease rates, right? You call this the canary in the coal mine. I feel like lease rates is another one of those terms where people's eyes just glaze over. Why does the cost to borrow a bar of metal matter so much?
It is the single most important metric right now. I'm telling you, if you listen to nothing else, forget the price. Watch the lease rate.
Why? What is it telling us?
Because the lease rate tells you the real stress in the physical market. Away from all the paper noise. Normally, if silver is abundant, the cost to borrow it is almost zero. It's less than 1% annualized. It's like borrowing a cup of sugar from your neighbor who has a 50 pounds bag in their pantry. They don't care. They'll hand it to you and say, yeah, pay me back whenever.
But what are we seeing now? What are the lease rates today? Hey, we are seeing sustained rates around 8% and recently intraday spikes in the London market hitting 39%. 39% interest annualized to borrow metal for a short period.
Just stop and ask yourself, why would anyone on earth pay 39% interest to borrow a bar of silver? It doesn't generate yield. It just sits there.
The only reason is sheer abject desperation.
Exactly. It means you are short. You promised to deliver metal to someone. You took their money and you do not have the metal. If you default on that delivery, you're out of business. You lose your license. Your reputation is shot. So you will pay anything, even these insane usurious rates, just to get your hands on a bar to hand it over and survive another day.
It's a payday loan for bullion banks.
That's a perfect way to put it. And high lease rates are the ultimate proof that the physical market is incredibly tight. Regardless of what that paper price on your screen says, you can manipulate the paper price with algorithms and spoofing. You cannot fake the lease rate. That is real money being paid by very desperate entities. So the bull case is essentially this. The vaults are draining at a historic rate. The actual buyers are demanding physical delivery like never before. And the banks are so short on metal, they are paying 39% interest just to keep the game going. And you layer on top of that things we see in the reports like China putting up export controls, essentially classifying silver as a strategic asset that can come into the country but can't leave.
Wow. It's like a game to them?
That sums it up. It's a game of musical chairs. There are 400 people dancing. There are 3 chairs left, and the music is starting to stutter. The bull case is that when the music stops on February 27th, the realization of the shortage will send the price into the stratosphere. And that sounds incredibly compelling. I'm not gonna lie, I'm getting a little bullish just saying that. But yeah, we have a job to do. We have to look at the other side, because the price did crash. The trade screen does say $70-some. So I'll play devil's advocate for us. Here's the bear case on why might the price stay down. And why might the bulls be wrong?
Alright, let's flip the coin. The bear case is rooted in 2 powerful forces, deflation and the house rules. And honestly, the bear case is just as scary as the bull case, but for completely different reasons. The core thesis here is the trend is broken. A global deflationary bust is coming, and the exchanges will simply change the rules of the game to prevent you from winning.
Okay, let's start with deflation, because silver is this weird hybrid asset, right? It's a monetary metal like gold, but it's also an industrial metal like copper, right? And that's its Achilles heel sometimes. Currently, the market is treating silver like a risky tech stock, not a safe haven. We call it the risk-off correlation.
I can explain that. Here's what it means in practice. When the broad economy looks shaky, when people start to fear a recession, they sell their risky assets. They sell Bitcoin. They sell Amazon after a bad earnings report. They sell Tesla. They want cash. They want the safety of US dollars or treasuries. And right now, the algorithms are programmed to lump silver right into that same bucket.
So if the Kevin Warsh nomination signals higher interest rates, which might be the pin that pricks the everything bubble and causes a recession, then the demand for everything industrial drops off a CLA. If we go into a deep global recession, factories close. If factories close, they don't need as much silver for solar panels or electronics. So the hedge funds see that coming and they sell silver to raise cash to cover their other losses.
Then, it's a liquidity crisis.
Exactly. And in a liquidity crisis, you don't sell what you want to sell. You sell what you can sell. Silver is for now very liquid. It has a deep market. So when a hedge fund is bleeding money on their tech stocks, they dump their silver to cover the margin calls on those other positions. That action keeps the price suppressed no matter what's happening in the vaults. And from a pure charting perspective, the chart looks terrible. We smashed below the 50-day moving average. The RSI, the Relative Strength Index, went from euphoria above 80 to panic down near 30. A pure technical trader, someone who doesn't care about vaults or lease rates. They just look at lines on a screen, looks at the silver chart right now and says that trend is broken. Don't try to catch a falling knife. They are actively shorting it because the momentum is down. They see a chart that looks like a classic bubble that has just popped. But the part of the bear case that really scares me the most isn't the recession. It's the change the rules argument. We've seen this before. It sounds like a conspiracy theory, but it's actually just well-documented history. It is history. And this is the single biggest risk for anyone who is betting on a physical squeeze. You have to remember the casino owns the table, and they write the rules.
You brought up the Hunt brothers in 1980, and then the 2011 crash in the notes. What specifically happened then that could happen again right now?
In 1980, the Hunt brothers almost successfully cornered the market. They bought up all the physical silver they could. The price went parabolic, hitting $50 an ounce, which in today's money would be hundreds and hundreds of dollars. The COMEX was on the verge of a default. The shorts, the big banks are going to be completely wiped out.
So, did they let the free market play out?
No number. They changed the rules overnight. They implemented something called Silver Rule 7.
Which sounds like something from a dystopian novel. Silver Rule 7. What did it do?
It declared the market liquidation only.
Can you elaborate on that concept for the people in the back?
Of course, it means you were allowed to sell your long contracts, but you were forbidden from buying any new ones.
They turned off the buy button, just like Robinhood did with GameStop, all those years later. It's the same playbook, and when you can only sell and you cannot buy, what is the only direction the price can go?
It collapses. There are no buyers allowed in the market. Instantly, the price cratered. The Hunt brothers went bankrupt. The banks were saved. And they did the same thing in 2011. They raised margins 5 times in 2 weeks to crush the price when it hit $49.
And there's also this concept in the rulebook of cash settlement or force majeure.
Correct. This is the fine print that nobody ever reads. The COMEX rulebook explicitly allows them, in the event of an emergency, to settle contracts in cash if they don't have the physical metal. This is the ultimate bear trap.
Okay, walk me through that scenario. How would that play out?
So you bet on a squeeze. You buy a March contract because you believe all the data we just talked about. You think there's a shortage and the price is going to explode to $500. The shortage happens. You were right. You go to take delivery. The exchange says, oops, sorry, no silver. We're declaring an emergency. And they force you to take a cash payment for your contract at the current market price. But at what price? You might be asking yourself. The price before the squeeze was recognized exactly at the settlement price before the explosion, or at a price that they in their sole discretion determine is fair.
So, let me just get this straight. I buy a contract. I am 100% right about the physical shortage. The exchange says, sorry, we're out of silver. And they hand me $75 in cash per ounce, even though the real street price for an ounce of physical might be $200 at that point.
That's the risk. You win the bet, but you lose the prize. That is the ultimate bear case. You get paid out in depreciating dollars that they can print. You don't get the scarce metal, and the squeeze is technically resolved on their books without the paper price ever having to reflect the physical reality.
Sheesh, that's terrifying. It's a heads I win, tails you lose situation for the exchange.
That has been the history of financial markets for a century. The house always protects itself first, and that is why the bears say don't fight the Fed and for God's sake don't fight the exchange.
So we have the bull case, which is physical shortage, versus the bear case, which is basically financial shenanigans. But there is a third player in this game that we haven't really touched on, the real economy section 4 here, industrial reality, right? Because you can print paper contracts and you can change rulebooks, but you cannot change the laws of physics. I love the quote from Majeure in our source notes. You cannot put cash in a solar panel.
Just cuts right through all the noise. Noise, doesn't it? Silver is the most conductive element on Earth, thermally and electrically. You cannot build a high-efficiency solar panel without it. You cannot build an EV without it. You cannot build a 5G tower or an advanced AI server chip without it. The modern world runs on silver. So if I'm Elon Musk, or if I'm a solar manufacturer in Guangdong, I don't care about the COMEX margin hikes. I don't care about Kevin Warsh's nomination. You don't care about the art. You care about your factory assembly line stopping. If you run out of physical silver, your multi-billion-dollar business grinds to a halt. Your revenue hits zero, and you can't substitute it easily with another metal without losing massive amounts of efficiency. So their demand for the physical metal is basically inelastic, completely. Think about it this way. There is maybe $1 worth of silver in an iPhone. If the price of silver goes from $70 to $200, the silver content in that iPhone now costs what? Roughly $3. Right? Does Apple stop making iPhones because the input cost went up by $2? Of course not. They pay it. It's a rounding error for them. But they must have the metal.
So the industrial users will pay any price. They are the price-insensitive buyer. And are we seeing evidence that these industrial giants are the ones panicking? That's the speculation around those January and February delivery numbers we talked about.
Yeah. When you see 98% of contracts standing for delivery in what's normally a quiet non-major month, that smells like industry fronter running the crisis. They're trying to skip the line. They are saying, I don't care what the price is. Just get the metal into my warehouse now because I'm afraid it won't be available at any price in March. They are draining the vaults before the financial speculators even wake up to the problem. And on the supply side of that equation, can't we just dig more? If the price goes up, don't miners just work harder? I mean, Economics 101 says a higher price brings on more supply for most commodities. Yes, the silver is unique. It's not a dial you can just turn up. First off, it takes 5 to 8 years, sometimes longer, to permit and build a new mine. So even if the price doubles today, significant new primary supply isn't coming online until 2032.
But what about existing mines? Can't they just ramp up production?
Here is the real kicker, and I think a lot of people miss this. 80% of the world's silver is a byproduct.
Explain that connection. I think this is really misunderstood.
Most silver doesn't come from silver mines. It comes from copper, lead, and zinc mines. The miners primarily looking for copper. They dig up all this rock, they process it for the copper, and they find a little bit of silver on the side. The silver is just the cherry on top of their revenue.
So, the amount of silver being mined depends on the global demand for copper and lead and zinc.
Yes. And think about the bear case. If the global economy is slowing down and we're heading into a recession and demand for copper for construction and industry drops, they mine less copper, which means they accidentally mine less silver too.
So a recession could actually decrease the supply of new silver, even if the price of silver itself is high.
Exactly. High silver prices do not automatically trigger more supply if the base metals market is weak. You aren't going to spend billions to dig up a copper mine just for the byproduct silver. It's not profitable. So the supply is stuck. It's inelastic, but the industrial demand is growing and non-negotiable. That is the definition of a structural vacuum.
This is just, it's wildly complex. You have financial suppression fighting against geological reality. Let's try to make this practical. Let's talk about how the list might actually be involved in this. Section 5. The investment vehicles. A lot of people own SLV, the big silver ETF, or they own mining stocks. How does this paper versus physical war affect those specific investments?
It's crucial. You have to know what you hold. Let's start with SLV, the iShares Silver Trust. During the crash last week, we saw something absolutely fascinating. There was record volume, a turnover of $41 billion. That's a huge amount of liquidity. Massive. But here's the interesting part. Despite the price dropping like a stone, the funds saw net inflows of about 1,000 tons of metal in a single day.
So smart money was buying the dip, people were selling their shares, but big institutions were coming in and creating new shares.
It certainly looks like it. Someone with very deep pockets stepped in and bought SLV while everyone else was panic selling. But, and here's the giant risk for the retail listener, SLV is a paper proxy for silver.
We keep coming back to this paper risk, don't we?
We have to. You, the listener, cannot take your SLV shares, call up the trustee, and ask for a bar of silver. Only authorized participants can do that.
And who are the authorized participants? Let me guess. The big banks, JP Morgan, Goldman Sachs, HSBC, the very same entities that are often short the market on the COMEX.
So if the COMEX breaks, and we go to that cash settlement nightmare scenario we talked about, SLV will likely settle in cash, or it will track the suppressed paper price. If physical silver is trading on the black market or in Shanghai for $200, but the official COMEX price is frozen at $75, SLV will likely be priced at $75. So owning SLV does not guarantee you participation in the real physical squeeze. It exposes you to that counterparty risk. You own a claim on a trust, which owns claims on metal. You don't own the metal itself. If the trust decides to settle its obligations in cash, you get cash. End of story.
Okay. What about the miners? Stocks like SIL, which is the big cap miners, or SILJ, the juniors.
This is the high-risk, high-reward leverage play. Right now, the mining stocks are historically cheap. They've been beaten down for years, relative to the metal. But just think about their business margins. Even at $70 silver, they're all in sustaining cost. The total cost to dig an ounce out of the ground and run the company is maybe $15 or $20. So they are making $50 of pure profit on every single ounce they mine. They are printing cash. Their balance sheets are pristine. Now what happens if silver does the bull scenario and goes to $200? Their profits don't just double or triple. Their costs stay roughly the same. So their profit margin goes from $50 to $180.
Wow, that is more than a 3x increase in profit. The stock price could go up 5 times, 10 times, even more for the smaller companies. That sounds like the winning play. Then, it has the highest potential upside. But remember the risk-off bear case miners or stocks. If the S&P 500 crashes because of a deep recession, the miners almost always get thrown out with the bathwater, at least initially. I remember in 2008, the silver miners crashed like 70% before they eventually rocketed higher.
Exactly. It's that liquidity crisis again. People sell what they can, not what they want. So if you decide to play the miners, you need an iron stomach. You have to be psychologically prepared to see your portfolio drop 50% before it potentially goes up 8,000%.
Okay, we are in the home stretch here. We have looked at the past, the present, the mechanics. Now we need the verdict. Section 6. We have about 3 weeks until the March crisis potentially unfolds. What are we watching?
The date to circle on your calendar in bright red ink is February 27th. First notice day for the March contracts. That is when the rubber truly meets the road.
And we basically have 2 scenarios playing out. Give me scenario A, the bull victory.
Scenario A is a break the comics moment. The March delivery demand stays historically high. We see 50, 60, maybe 80% of contracts standing for physical delivery. The registered inventory in the comics vaults drops below a critical psychological level, let's say 80 million ounces, and the market finally realizes the emperor has no clothes. Panic buying sets in. The shorts are trapped. The price snaps back violently to over $100 and starts heading for those higher targets mentioned by analysts like Michael Oliver, $300, maybe $500. The paper market finally fails to suppress the physical reality. The vaults go empty.
And scenario B, the bear victory.
The empire strikes back. The exchange continues with margin hikes. The Fed talks tough about interest rates, strengthening the dollar, and spooking the risk-on crowd. And crucially, the exchange manages an orderly cash settlement behind closed doors. They tap the big contract holders on the shoulder. They call them up and say, look, take this cash premium and just go away quietly. They discourage delivery by making it difficult or expensive. And the price in that scenario, the price drifts sideways or consolidates in this lower range. The squeeze is postponed yet again. The can is kicked down the road one more time.
So as a listener, what is the one piece of data I should check tomorrow morning when I wake up?
Don't look at the price first. I know it's hard. Look at the daily vault data from the COMX. Watch the registered category. If it keeps bleeding 500,000 or 700,000 ounces a day, every day, we are heading for that crunch.
And the lease rates.
And the lease rates, if they stay elevated above 10 or 20%, the physical shortage is real. Period. That is the heartbeat of the physical market. You could ignore everything else, but you can't ignore that.
This has been intense. It really feels like we are watching a slow-motion train wreck, but we don't know if the train is carrying gold or dynamite.
That's a really good way to put it. We are at a bifurcation point. The market has to choose one of two very different paths in the next few weeks.
To wrap this all up, the outro. We usually try to leave the listener with a thought that goes beyond the data, something a little more philosophical to chew on.
Yeah, I've been thinking about this decoupling idea a lot. We might be moving into a world where the price you see on your screen becomes, well, irrelevant. We are so used to checking an app to see what our house is worth, what our stocks are worth, but if the exchange forces cash settlement because they run out of physical silver, the price of paper and the price of physical silver could permanently split.
You mean like a two-tier market where there are two different prices for the same thing exactly? We could see a world where the screen says $75, but you cannot buy a single 1-ounce coin in the real world for less than $200. The screen price becomes a fiction, a museum piece of a market that used to exist. That is a profound shift. It challenges the whole modern idea of price discovery. It would mean the market is fundamentally broken.
And it leads to the final provocative question for everyone listening. If you hold a contract that promises you silver, and you get paid in depreciating dollars, because the silver's all gone, did you win or did you lose? You held the winning lottery ticket, but the casino paid you out in poker chips that they are actively devaluing at the cashier's cage.
That is a terrifying thought to end on, but it is the reality of the game we're in right now. Keep your eyes on the vaults, everyone. February 27th is coming up fast.
Thanks for listening in, everyone. This is Keri.
And this is Ian.
Let us know what topic you want us to talk about next. Links to all of the videos and articles that we researched are in the description. We are AI podcast personalities, creative for Pocket Market.
That's right. Subscribe, comment, share. It works better in that order. We are going to be here every week.
Every week?
Yes, that's right. Every week, whether you like it or not. Thank you for listening. We hope we provided some value to you.
Comment down below to share a topic you want to know more about. And look at our playlist for Options Trading Basics, where you learn the very basic definitions and concepts to options trading. See you next time. This has been Fly or Fall Stock Market Analysis.